joining us from Denver, Colorado. Andy, look, ICE.
Good morning,
It's
Kristen.
great to have you. Good to see you. ICE's U.S. conforming a 30-year fixed mortgage rate did a dip to 6.2% roughly ahead of October's Fed decision. And according to your research, are we starting to see more refinance activity as these rates have come down?
Yeah, absolutely we are. So if you look at where we were entering the month of November, we had the highest volume of refinance incentive that we've seen out there in the market in 3.5 years. You've seen a rebound in refinance demand come along with that. If you look at the Mortgage Bankers Association refinance index for September, roughly 40% above where we peaked out last September, even though interest rates were a little bit lower last year than they are this year. If you look at the month of October, roughly twice the refinance index that we saw at this point last year. So some of those homeowners that have been waiting in the wings for that refinance opportunity to present itself, finally jumping in and taking advantage.
Yeah. Now, as these rates come down, are we seeing new borrowers actually qualified to refinance in this space?
Yeah, and if you look at it by the numbers, right, it's really the bulk of activity is coming from recent refinance originations, right, or recent borrowers that have purchased over the last couple of years. 75% of folks that have interest rates in the high 6s and 7% range have taken out their mortgages in 2023, 24, or 25. They're also the most active borrowers in the market as well. So a lot of this volume coming from some of those marry the home, date the rates that are getting ready to date a new rate here as we get towards the tail end of this year.
Mm-hmm. Any other trends standing out to you, at least when it comes to homeowner equity?
Yeah, homeowner equity has started to plateau a little bit, right? We have $11.2 trillion of what we call tappable equity in the market, equity that could be borrowed against while still maintaining a 20% equity cushion in folks' homes. So that's starting to flatten out along with overall home price growth flattening out. I think the more interesting trend from an equity standpoint is the cost to withdraw that equity. As the Fed has started to cut rates, the cost to take out an interest rate on a second lien home equity line of credit has improved. If you look at just the monthly payment on those second lien lines of credit, down by about 25% over the last 18 months. And then if you look at the projected Fed rate path forward, it could cut that cost to withdraw equity by another 15 to 20% by the time we get towards the tail end of 2026. So some opportunity there for homeowners to tap into some of that equity at a lower interest rate, some opportunity for lenders out there for some additional second lien home equity lending volume as we move throughout the tail end of this year and through 2026 as well.
Now, as we're past the typical busy summer buying season and, of course, approaching the holidays, Thanksgiving is just a few weeks away, how have we seen purchase demand fare during the fall?
Yeah, we've seen a pickup there as well. In fact, 9 of the 10 strongest weeks, seasonally adjusted, over the last 3 years have come in September and October. So you're certainly seeing some rebound in purchase demand out there in the market. Home affordability in September hit its best levels in 2.5 years. And so along with that improved affordability has come a little bit of improvement in demand as well. Now we're still subdued from where we traditionally would be out there in the market, still 25-30% below of where we were entering the pandemic. So still some compression out there. But you're seeing some positive signs there in that when interest rates are coming down and affordability is improving, you're seeing some home buyers out there, again, waiting in the wings to step into that market as well.
Mm-hmm. Now, according to your latest report, annual home price growth did tick up to nearly 1% in October, breaking 9 months of an actual slowing. What does this say about the space?
I think it says a couple of different things. One is that it's still soft out there, right? Even despite the uptick, it's still sub 1% growth in home prices. That's a quarter of what you traditionally see out there in the market. So still soft dynamics. But what it is signaling is that increased purchase demand out there, that modest improvement that we're seeing on improved home affordability is running into a little bit softer inventory levels, especially in some of those markets where home prices had been coming down over the last few months. Sellers had been taking a step back. Inventory levels had started to fall in some of those southern markets. In western markets, again, that had been seeing home prices ease this summer, and it's leading to a little bit firmer home price dynamics out there in the market. So again, still soft, but a little bit of improvement. When you look at the number of markets that are seeing prices come off of their recent highs or come down on a month-over-month basis, 4 months ago, it was about half of markets that were seeing home prices come down. In October, it was about a quarter. So again, going back to that same theme. It's a little bit softer price dynamics, but firmer than what we've seen in recent market.
Andy, we have one final rate decision due, at least planned, on the books between now and year end. Of course, the Fed's latest rate decision expected to come in mid-December. What is your expectation for the path forward for interest rates and thus the impact on the housing market?
Yeah, and I mean, when you look at the expectation from the market, it is still for the Fed to cut towards the tail end of this year. Not quite as certain of an outlook as it was a couple of weeks ago, but that's the broad expectation. When you look at what that means for the housing market, most of that is already priced into mortgage rates. So if you look at our ICE 30-year mortgage rate futures, anticipation is that mortgage rates come down maybe 0.1% by the time we get to the spring home buying season next year. So maybe a little bit more affordability than there is out there in the market right now, but not a massive move expected. So similar overall trends there for home prices, maybe a little bit affirming here in coming months. But I think inventory is really going to be the key to watch to tell us where prices go and the housing market goes going forward. Do we continue to see sellers list at a little bit higher rate like we saw in September or in October? What do we see from an overall supply picture, which has really been kind of a flat dynamic over the last few months? Do we see any kind of rebound there that could give us some more inventory as we head into the spring?
All right, Andy Walden, ICE's head of mortgage and housing market research, joining us from Denver, Colorado. Andy, thank you as always.
All right. Thank you, Kristen.